Hey everyone, in this video I'll be explaining what the first time home buyers incentive exactly is, what it means, and the details. I won't go into if it's a good deal or a bad deal, if it's worthwhile. However, in a future video I'll definitely do that. But for now, for this video, I'll just be explaining all the details in case you're confused or don't really know what the first time home buyer incentive means or does for you. Before we get into it though, please, as always, subscribe and ring the bell. You can find the details of my social media and the Gmail you can contact me at, both Saberisixrealestate in the description. As always, leave a comment. If you think this video sucks, leave a comment saying this video sucks. Give me a thumbs down. At the end of the day, it's just engagement for me, which I like. So please, before we get to this video, go ahead and do that. Thank you. The best way to start thinking about this first-time home buyer's incentive is as a first-time home buyer's loan. The term incentive in the name of the first-time home buyer's incentive can be a little misleading. Let's be honest, most incentives, at the end of the day, you end up saving. For instance, tax incentives. Corporations, as an example, get tax incentives to hire co-ops, because in that sense, half of the salary or the wage of the co-op is paid by the government, and the corporation is incentivized to do so because they end up saving. With the first-time homebuyer incentive, although in some sense it incentivizes first-time homebuyers to take action and get involved with the market, you're not saving the amount. What's happening is you're getting an additional loan on top of the mortgage loan you would have to take out, and the loan would be paid somewhere down the line. So if you start thinking about this as a loan, as a first-time home buyer's loan, then in my opinion, you're better equipped to think about what this government policy actually is. Now, what exactly is this loan you would be receiving? What are the details? How much would you have to put down? When is it due? What are the minimum requirements? What this first-time home buyer's incentive does is that the Canadian government provides a certain percentage of the total purchase price of a house you want to buy. Now, how much is that percentage? Well, it differs from if it's a resale home or a newly constructed home. In the case of a newly constructed home, that is to say a house that no one has ever lived in, it's never been sold other than the fact that the developer bought the land. With that, the Canadian government is willing to provide 5 or 10% of the purchase price for you. With resale homes, which is more common in the market, the Canadian government under this program provides 5% towards the purchase price. So using very simple math and frankly, to be honest with you, unrealistic figures, for instance, let's say you want to buy a house that's a resale house for $400,000. If you meet the minimum requirements, the Canadian government will provide you with $20,000 towards the purchase price of $400,000, because at the end of the day, $20,000 is 5% of $400,000. I know, brilliant. Now, obviously, this amount would be in addition to the amount that you yourself are putting down, which as a minimum requirement for this program would be 5%. And the remainder would be mortgaged. So as you recall, I said this is best to think of as a loan on top of another existing loan you would have to get, because the mortgage itself is also a loan. And this $40,000 that the government is providing you with in this example is not a free $40,000. You would have to pay this in the future. Before we get into the payment details as to when you owe this amount of money that the government is providing you with, let's go into the minimum requirements of this loan. One of which we've already discussed, which is you would have to yourself put down 5% of the purchase price down, and the Canadian government would match it in the case of resale homes and even exceed it in the case of newly constructed homes. Now, the second requirement might be very obvious to you, and it's very obvious to me, but you know, a lot of stupid people watch YouTube videos, so I might have to explain this one. It is a first-time home buyer's incentive. Now, all joking aside about calling people on YouTube stupid, which I shouldn't do because I'm not that smart all the time either. This first-time homebuyer's incentive criteria of being a first-time home buyer can get a little complex. For instance, a question might be asked, am I a first-time home buyer if I've been married to a spouse and he or she has purchased a home that's in her name, and that's also, she pays the mortgage for, she pays the property taxes for? Am I still a first-time home buyer? Well, under Canadian law, more specifically common law, if you and your spouse have purchased this home, even if you're not on the title, and you guys have occupied this home as your place of primary residence, that is to say, you guys have lived there most of the year, and it's not a investment property, it's not a commercial property, obviously, and it's not some sort of cottage or villa, then no, you would no longer apply for this program because you're no longer considered a first-time home buyer. Now, interestingly enough, something I didn't know before doing research for this video is that if you were to divorce this spouse of yours, which please don't, it would break my heart, but if you were to do it, the spouse of yours that pays the mortgage and is on the title, now you're divorced, you were actually requalify as a first-time home buyer because you're no longer married and you guys no longer have a principal residence as common law couples. The third requirement on top of the first requirement, which we discussed, which was you would have to put down 5%. Second requirement, you would actually have to be a first-time home buyer and meet all the details that entails, that the definition of first-time home buyer entails. The third requirement is that the household income, whether it's just you or if it's you with another person, the household income of the family unit or a person that's applying for this incentive program cannot exceed $120,000. The fourth requirement for this first-time homebuyers incentive is that you cannot ask for a loan that exceeds 4 times your household income. However, it has to still be lower than $120,000. So using this logic, if it cannot exceed 4 times your household income and it has to be lower than $120,000, then the maximum amount you can apply for is 4 times $120,000. So just to quickly give an example of this fourth condition, this fourth requirement. For instance, let's say your household makes $110,000, right? It's still below the 120 figure. That's the third requirement. However, the mortgage amount you would be taking out with a bank or a broker cannot exceed 4 times $110,000, according to this fourth condition. So that means you can only apply for a maximum amount of $440,000 because 4 times 110,000 is 440,000, right? So you can apply for more. That is to say, you can try to get a mortgage for more than $440,000. However, once you do, you no longer qualified for this home buyer's incentive. They will no longer put down the 5 or 10% depending on if you're buying a resale or a first-time newly built home. So the last thing I want to mention regarding this program, and the most important thing in my opinion, is that I'm very beautiful and you should subscribe to me because I'm gorgeous. But other than that, there's one other thing. When is this loan due? If you recall in the beginning of the video, I mentioned that this is a first-time home buyer's loan. So it's better to think of it as a loan than an incentive. Because if the government puts down $40,000 towards your down payment, they expect it back at some point, right? So it's under 3 scenarios that you would have to pay back this loan. Scenario number 1, you sell the house. So let's say you sell the house for $550,000. Initially, the government helped you out with $40,000 because of this program. You would have to deduct $40,000 from the $550,000 you sold the house for. Number 2 is if you refinance the home. So that is to say, let's say you get into some financial troubles or you want to open up a business on the side and you need extra equity. Once you refinance the house, you would have to pay back the loan in the process. And number 3, and the last one, is the maximum life expectancy of this loan. That is to say, you would have to, if you don't sell the house or if you don't refinance, you would have to pay it back in 25 years, right? So whether you've sold the house or not by then, you would have to pay it back in 25 years. So basically, logically, when you think about it, what it comes down to is putting the refinancing condition aside, you would have to pay back this loan in 25 years or when you sell it, whichever one comes first. And yeah, that's all you need to know for now for this first-time home buyers incentive program. As always, I'm Sam from Saberisixrealestate. Yeah, please subscribe, comment, and yeah, I'll have more videos coming for you guys soon. Thank you.